Dozens of retailers have filed for bankruptcy during the COVID pandemic. Some of them, like J. Crew, Brooks Brothers, and Neiman Marcus, are the lifeblood of America's shopping malls. And with the fate of these brands teetering on a razor's edge, some mall operators that are sitting on cash are pulling these storied retailers out of bankruptcy. But there's a catch. Let's bring in CNBC.com retail reporter Lauren Thomas, who has more details on these risky bets for us. Lauren, how are they playing out?
Yeah, Kelly, thank you first off for having me today. I think it's a really important story to be following just as this landscape clearly evolves during the pandemic. So it's not necessarily private equity, money getting involved here to rescue these retailers. It's some of the biggest mall owners in the country, namely Simon Property Group and Brookfield. So far what we've seen is Simon has already, with Authentic Brands Group, which is an apparel licensing firm, supplied an $80 million loan to help carry Brooks Brothers through bankruptcy. Simon and Authentic Brands are also the stalking horse bidder for Lucky Brands, which has declared bankruptcy during this pandemic. And a source tells me that Simon, with Authentic Brands and Brookfield, is also looking at rescuing JCPenney from bankruptcy. But the key thing really to know here and to pay attention to is there's not really a good case study to follow to determine, if this is ultimately going to pay off. Simon did buy Aeropostale out of bankruptcy in 2016 with Authentic Brands and Brookfield. Simon, the CEO of Simon, David Simon, has said that the company did make a lot of money on that deal. But I just think this really is going to be something to watch to see if it ultimately pays off for them. But certainly a lot of risk involved when I talk to analysts and investors.
No, and it's interesting you bring up the Aeropostale example where that did seem like a successful turnaround. As the company said, they, quote, made a ton of money on it. Yeah. So right. Either this is that on a larger scale and investors would be thrilled that they were able to buy low, sell high, or it's an acceleration of the demise of chains that were going bankrupt anyway. And in that case, these would be terrible bets.
Sure. Well, I think the key thing, again, to remember here is in a lot of these cases, these retailers, they're huge tenants at a Simon, within Simon's portfolio, within Brookfield's portfolio. And again, probably not every mall owner could be making these types of bets. When you look at Simon, they've got one of the biggest and best balance sheets in this space. They issued an investor update at the end of June and had about $8.5 billion of liquidity, and that included $3.5 billion of cash on hand. You look at, Aeropostale, for example, split among those three companies. That was about a $240 million deal. So it's not, when you're Simon, it's not a ton of money. But still, I think the goal is to make these businesses profitable, and, control, obviously, the stores that they do still have within their malls.